Credit Suisse, one of the most successful banks in the world and a country known for its banking sector, has collapsed, taking with it billions of dollars in investor capital. At the center of the collapse was a little-known financial instrument called an AT1 bond. What is that? Well, up until a few weeks ago, pretty much no one knew what an AT1 bond was or that it even existed. But what are these bonds? Why are these bonds so important? And what can they tell us about the current banking crisis? Let's dive in. First off, AT1 stands for Additional Tier 1. These types of bonds are issued by banks in order to drum up more working capital. They need more liquidity, they issue these bonds. AT1 bonds emerged after the '08 financial crisis as part of a European regulatory banking framework called Basel III. This agreement required banks to maintain a much larger portion of financial buffers on their books than they did prior to the global financial crisis. Now, let's talk about the key word with these bonds, additional, because banks have two main tiers of capital. Tier 1 and Tier 2. Now, I'm not going to get too much in the weeds here, but typically Tier 1 is more risky, Tier 2 is less risky, and there's other additional tiers that successively go down in risk as you go up. Now, Tier 1 is the primary way that the banks fund their business activities, and the primary asset inside the Tier 1 capital silo is equity, in other words, stocks. But this is why additional Tier 1 bonds is so important. Because when most people think of bonds, they think of safe, non-volatile, hold them until you die assets. Usually, they're backed by the government or some really old, really big blue-chip company like GE. But that's not what AT1 bonds are. Remember, they're in the Tier 1 level of the capital structure. So in terms of regulatory risk, they're right beside the share equity of the bank. Now, this is where AT1 bonds get weird. If a bank collapses, usually you pay out the bondholders first. This is standard doctrine among the financial ecosystem of the entire world pretty much. But with AT1 bonds, there is fine print that nobody read or nobody talked about prior to the Credit Suisse downfall. You see, when a bank's capital reserves fall below a certain level, AT1 bonds convert into equity. So they're no longer bonds. They've transformed. This mechanism was designed as a sort of life raft for banks if things got really bad. They lose all their money, and all of a sudden, that money held up in their issued bonds can be used as emergency funding. And that's where it all went wrong for a lot of people. Because when Credit Suisse failed, the Swiss government decided to write off all $17 billion worth of the bank's AT1 bonds in order to reduce its liabilities and make recapitalization easier. So, all that money that people thought was safe in one of the biggest, most successful, supposedly banks in the world is poof, vanished. Now, what does this mean in the grand scheme of things? Well, plenty of other banks have AT1 bonds on their balance sheets, particularly in Europe and specifically Deutsche Bank, which seems to be perpetually in danger of insolvency. But the larger question is, who was holding these AT1 bonds when they were liquidated? Because it has the potential to send shockwaves through the banking industry and further destabilize the banks if all this money goes poof overnight. Well, it's not mom and pop investors. Your grandma isn't going to be holding AT1 bonds in Credit Suisse. So she's okay. And it's also, surprisingly, not the other big banks either, like JP Morgan or Goldman Sachs. Because it's generally frowned upon for lenders, banks, to own the capital instruments of competitor banks. For instance, in Japan, there's a 1,250% risk weight for buying another bank's AT1 bonds. That means for every $1 of AT1 bonds that a Japanese bank buys, they have to hold at least $1 of their own equity. Which means that basically, they're not going to do it because it doesn't give them sufficient leverage. But who really held the majority of these bonds? Well, it was really held by wealthy family offices in the Middle East and Asia. As Asia has grown in economic importance, they became the crown jewel of Credit Suisse's private banking division. So in all likelihood, they've probably lost a lot of money from the bank's collapse. However, the whole ownership of these AT1 bonds is about as opaque as the bonds themselves. So it still remains to be seen who is left holding the bag and how that will affect the markets going forward. But hopefully, this has given you a good primer on AT1 bonds and dispelled some of the confusion I think we've all been feeling over the last week or so. Thanks so much. My name is Alex Reed with WealthPen, and if you enjoyed this video, please don't forget to like and subscribe.